Good morning, everyone, and welcome to the Prosperity Through Multifamily Real Estate Investing Podcast. I am your host, Real Estate Cody, and with me, as always, is the one and only coffee connoisseur himself, Brian. Good morning. How are you?
Doing well, Cody. Nice to see you again. I'm excited about our show today.
I am as well. We have right on the heels of, I think it was the Memorial Day holiday and, honoring our military men and women in services. And so we can't thank them enough for their services. So really excited to have our guest on today. Tell us who that is.
Yeah, it's an absolute honor. So today we have Kevin Brenner from ADPI Capital. So Kevin is a University of Miami graduate with a bachelor's in atmospheric science and a former top Pentagon Air Force meteorologist. That's super cool. Kevin is not your typical Wall Street fund manager. Rather than pursue an expensive finance degree, Kevin spent years meticulously educating himself in every facet of multifamily real estate, from syndications to underwriting to fund management. Apart from serving his country, Kevin is a well-recognized military real estate investor, coach, mentor, and host of the top-rated active duty passive income podcast. With over 450 plus thousand downloads worldwide, Kevin's growing influence and network in the real estate space has helped him expand his personal multifamily portfolio. A passionate educator, Kevin is active duty passive income director of single family education, where he coaches over 250 plus military real estate investors how to succeed in real estate. Kevin, welcome to the show.
Thanks, Brian. Thanks, Cody. It's a total pleasure. And I got to know more about this coffee connoisseur stuff, dude. You're holding out on me.
We get that question a lot.
That's a whole nother podcast for
a whole nother podcast.
But he will send you a nice bag of coffee from his coffee shop if you'd like. It is really good. So,
hey man, I'm about it. I bought this book for my wife, and it was called God, I forget what it's called, but it's like a book, like a how to, like all the different methods to do coffee and everything, right? And she hated it, but I loved it. You know, when you get a gift and you're like, oh, I think you'll really like this. And yeah, but I've learned so much from that book, and I learned how to properly make French press. But I'm ashamed to say I did have a K-cup this morning. So sorry.
What's the thing about coffee is this is not a coffee podcast, but the issue most people have is they want instant gratification. They wake up and they don't want to do any work. It's but making a good cup of coffee is probably going to take you 10-ish minutes in the morning. If you're, steaming your water to the right temperature and you're doing it the right way, you're making a pour over, you're making an AeroPress, a French press, a Chemex, V60, a Kalita. There's a long list. You're talking 7, 8,
it's
9,
art,
10
baby.
minutes.
It's art.
It's art. Yeah. So, but if you just want to wake up and you're half asleep and you want to press a button, a K-cup's a good option.
See, Kevin, everything Brian just mentioned is all a foreign language to me. I'm like, what in the world did you just say? I have no idea.
Brian, I'll get you this book, man. I'll get you this book.
Brian, you should start your own coffee podcast. That's what you should do.
Coffee and Real Estate. That's a great show title.
There you go.
Hey, Kevin, man, we appreciate you having on the show. Really looking forward to this. And like we mentioned to you before the show, man, really appreciate, your service and your commitment to our country. So thank you so much for that. And glad to have you here. And like we mentioned, we had a fellow colleague of yours, Mr. Tim Kelly, on the show about 2 years ago, which was our introduction to ADPI, and love what you guys are doing for the military community in introducing real estate investing to that community and fostering an environment of, networking, education, and whatnot, so people can, take control of their financial freedom. So just love what you guys are doing over at ADPI. You always represent very well. But before we get into that, man, I got to ask you, what in the world's going on with the University of Miami, man? Are you guys like, man, you took a tumble from the cliff and then
I have no idea. I am the worst. Okay. So I'm the worst sportsman. I went to school. I enjoyed it. Got this in my bio, got this degree, right? And I was a meteorologist for 9 years, meteorologist. Did not enjoy that too much. I mean, it was fun. It was easy for me, right? I needed a challenge. But as far as school and college sports and stuff, man, I don't even know. I can barely keep up. I'm knee deep in like Wall Street Journal, and I should be in like, I don't know, Sports Illustrated. I have no clue. So unfortunately, I can't answer that question, but I'm going to assume that they're doing terribly. And you know what? They can only go up from here.
There you go. That's an optimistic view. I like it.
There you go.
Well, Kevin, man, tell us a little bit more about your background, buddy.
Yeah. So, Air Force, 9 years. I'm actually still in the reserves. I have a reserve gig at the Pentagon here. I live in Washington, D.C. with my wife. And, about 4 years ago now, I took the plunge into real estate. Started out like a lot of people do in the military. They have a VA home loan, right? And I went and bought a quadplex with it because you can get up to 4 units with your VA home loan. And I was like, okay, let's do that. And let's rent the other 3 out. Long story short, I ended up getting orders to come to Washington, D.C. So I couldn't even live in that place. So I kept the tenants in there. We renovated the units. We got the bad tenants out. We got the great tenants in. We, raised rent over 50%. I think they were renting for $600 to $700 a month. We're now renting them for $1,400 per month per unit. And, it's in Savannah, Georgia. And about 6 months after I closed that first one, I was like, hey, you get that first rent check, and you're like, this will do. And then, so I raised some capital and got one down the street, another quadplex. It's like this neighborhood of quadplexes, right? They're all built in the 50s. And we did the same thing, renovated it, did the whole thing. And at this time I was getting involved in active duty passive income in the community, and kind of just sharing my journey as I was renovating these units, and started helping out on the podcast, and now I have that show, and just growing that community. And from there I decided, okay, multifamily is the way. How can I get more? And I started really, really diving into the educational side on a lot of things, obviously syndications, your 506Bs, your 506Cs, all of that stuff. But really diving deeper into funds and how those work. Got myself some educational courses, masterminds, did the whole thing, jump in feet first. Actually started a private equity company myself. We got some deals with it, and we since shut that down. But in that was kind of my learning experience. That was my crucible, right? Where you just learn, you make a ton of stupid mistakes, but you learn at the same time. And I learned so much about funds, and I learned how not to set a fund up. And I took that knowledge and I went back to, Markian and Markian Sitch, the CEO, and then Tim Kelly. So Tim and I were sitting in Markian's house in New Orleans, and we're talking business, right? We're actually recording content, for the company. And we're down there, and I told him, I was like, hey guys, we should really consider doing a fund. And they had no clue what that is. Tim, well-versed in the syndication side, like you guys, right? But not really understanding what the fund is. And Markian had some JV stuff going, and some assisted living, multifamily and stuff. But from there, we started these conversations. We can crowdfund. We have this community. We've meticulously built an active duty passive income. Now we're up to 55,000 real estate investors in a community. We're constantly nurturing with great content, educational content. We're helping them with their questions. We have that bond, right? You guys aren't veterans, right? But like it's hard to explain, but when that someone else is in the military, like how people have like their walls up when you have like a conversation, you're kind of like, oh yeah, you're feeling this person out, when you're meeting someone at like a conference, when you find out that they're in the military or they were in the military, boom, walls down, because you can just talk shop. It doesn't matter what service, and that bond has helped grow ADPI, right? Because you have that instant trust that we're here, and you combine that with the fact that the founders are super experienced in real estate, and we're sharing all of this knowledge and helping people, and we have tons of success stories, and that grows the community. But the number one question we were getting was, how can, this is people from the community, how can we invest with you? We see the Eric Upchurches of the world, the Tim Kellys of the world, Adam Labar, and all of these people who are closing these like massive multifamily complexes, like 200 units here, 300 units there. Oh, a self-storage facility there. And they were like, well, yeah, I want to get in on that. And the solution at the time was like, well, yeah, come on in. We got a syndication here. Are you accredited? Nope. Do you have $50,000 minimum investment? Nope. Do you have, so like all these barriers are instantly set up in the system. And, so we're in Markian's living room, and I'm talking to Tim, and we're trying to strategize. Well, why don't we crowdfund this? How does that work? And that led us down the path of a Reg A, which led us down the path of a Reg A plus tier 2, which is a fund structure. I mean, it's an exemption, just like your Reg D, right? It's a way to structure a special purpose vehicle that allows the issuer, AKA us, right? ADPI Capital or active duty passive income, right? It allows us to really raise capital without those common barriers. I mean, your minimum investment can go down as low as $10. So that barrier is gone. You have to be accredited? Nope. That barrier is gone. Can you market to anyone you want? Yep. Freely market to whoever you want. You know, and we'll talk more about the pros and cons of it all, because there are cons. You know, it's not like a magic bullet solution. But for the syndicators who are listening to this show, if you've never heard of it, it's worth the research, because if you have a community of people already, you can open up the floodgates if you set this up properly. So that's where I'll leave it.
Well, Kevin, appreciate that introduction and this very timely topic. I think most people probably within the multifamily space, unless you're new, have some familiarity with the term fund, but not really understanding the intricacies behind it. Because like you said, there's multiple different ways you can structure a fund, and there's multiple different strategies you can utilize a fund. So that's great. Before we get on that, I definitely want to make sure to also send a referral out to Adam Labar. We had Adam on the show as well. So if he's listening, I want to make sure to give him a shout out as well. Also great conversation. So appreciate the name drop there. But yeah, you know, I think looking at the fund model, you know, it depending on who you're listening to, as far as capital raisers in the space, other influencers in the space, you know, there's a lot of people that believe like the fund structure is actually the future of capital raising, especially from the retail investor. And so I definitely want to expand on that. Brian, what do you think?
Yeah, we're seeing a lot of successful operators that have a track records pivot their business to a fund model, because they have a lot of investors that are interested in investing, and sometimes you don't always have a deal, right? Or you want diversification, which again, we're getting into the nuances and the intricacies here, and how you can sort of hedge a little bit of your risk by not putting it all in one asset necessarily. So I definitely agree that we're seeing this become the future of capital raising versus doing it on a deal by deal basis, especially if you're entry level or newer, maybe you've only been in the business a few years. Capital raising is a huge challenge right now. The sophisticated operators are going to get it first, and the fund can kind of give you a little bit of a push in the back, so to speak, to kind of jumpstart your business, especially if you're out there and kind of putting funds together. Maybe Kevin has a fund, we have a fund, we kind of join together and, you know, go buy a $100 million deal or whatever, right? So there's a lot of creative ways to get things done with a fund.
Yeah. Well, and Kevin, you brought up a really good point, and I think this is something important to highlight. I'm sure a lot of our listeners may be kind of questioning this as well. Is with retail syndication where it is today, the barrier to entry is getting much higher for the non-accredited investor. You know, I mean, I hate to say, but most of your non-accredited investors are kind of essentially getting priced out of private placement opportunities. And it's leaving them very frustrated, because they want to be actively invested in multifamily, commercial real estate. They like private placement, but they're just not being given the opportunity. So I love this approach of looking at, you know, the Reg A model and how that could be a benefit. So let's kind of start there. Let's talk about, you know, what is a Reg A model? Then we could take it to the Reg A tier 2 and kind of go from there.
Yeah. So, I mean, I think to start, you got to kind of look back before you can look forward. So all of this kind of changed around 2018 because the rules changed. And, you know, if you're not following what the SEC is doing and you know, exemptions and rules changing, then you're never going to know. Right. So the people in the know have been doing this for a while. And you were essentially limited on how much you could raise in a year. And then there was also some other limitations on how you set it up and things like that. So in around 2017, 2018, the rules changed, and it went from you can raise up to 5 million a year to 75 million a year. And keep in mind, the Reg A is not designed for real estate. It's we in our space, we're now, it's not, I want to say it's commonplace, but the new wave, like the cool thing to do is to set one of these up and apply it towards real estate, but it's really used for VC stuff, like and like setting up legit like tech companies or something that are trying to do massive raises and crowdfund and you know, get people involved that way. And it's known in the industry as a mini IPO. So your initial public offering, right? Like that's where you go public on, and the stock exchange and all that stuff. This is a mini public offering. So putting that out there, when we talk about the cons, it's a lot of paperwork and it's a lot of legal fees. This is not one of your things where, I'm going to go and get my SEC attorney and $12,000 later, I'm going to have my Reg D 506C set up. Try like $120,000 later. You're going to get this set up in 6 months, because you're actually, so unlike the Reg D and whether you're doing a 506B or 506C, as an issuer, you're actually registering with the SEC. Like you are full on registering with the SEC, and they're commenting, and then we're commenting, and we're kind of working out, the intricacies of how to get this fund done. You're not just saying like, when you do a Reg D, you're just like, hey, I'm exempt from this. Like here's my exemption letter. It's not like that. So there's a time element. It's about 6 months to set up, and there's a cost element it's about 10 times the cost to set up. So if you think about it, if you have a single asset that you're trying to syndicate, well, I don't know many deals that are going to be under contract for 6 months plus while you set this up. I don't know. I mean, I guess if you're a good negotiator, maybe, but I would, in today's market, I don't think so. So for single assets, the syndication is probably going to be your better route. And when I say syndication, I'm talking about your Reg D, 506B or C. But Cody, like you said, for folks who have a community or who already have a large investor list, you can use the Reg A. Now that you can raise up to $75 million in one calendar year, you can use the Reg A to build a stockpile of capital. And then you have that, and it makes you super competitive in the market when you're looking for deals, because you have that edge over that syndicator who said, yeah, I'm totally into this, and yeah, we're going to raise the capital for you. We got this. We're going to raise it. Nuh-uh. When you're a fund, you're just stroking checks because you have the capital already. You're underwriting the deal already, and it's how much do you need and how much equity are you going to give me? Kind of play like that. So you have a lot more power. So, there's certainly that aspect to it. But I think, when we talk, and tell me, like, cut me off here, guys, if you have questions, but like, do you want me to go into kind of more pros and cons as well of the whole thing, or just talk about how to structure it?
Well, I want to kind of dive into how this is applicable to deal acquisitions before we kind of dive too much further in there, because you brought up a really good point. Right now, especially in this market cycle, the sellers are concerned with surety of close. And the biggest question mark is, what is the source of equity, right? We've kind of seen a softening in pricing. Expectations are kind of adjusting, but how are we going to be sure that this deal gets closed? And that always comes down to sources of equity. So to your point, I definitely think there's power in having a Reg A available or your fund available to say, hey, the capital is just, it's completely discretionary. It's here. We just got to write the check. But how are you actually applying that to individual acquisitions? Because you mentioned, you can have a fund that's isolated to maybe just one acquisition, like a special purpose vehicle. But in a Reg A fund, are you looking for more volume, or is it deal by deal? Talk to us a little bit more about that.
Yeah. So when we, and I'm sure Adam and Tim talked about the active duty passive income community, and I touched on it, 55,000 plus real estate investors, military real estate investors, excuse me. Part of that community, part of what we built, and kind of in my bio, you guys touched on it, where I teach the single family side. So I'm doing the short-term rentals, the flipping, the BRRRRs, the, small multifamily stuff. We have a whole nother side that Tim teaches, Tim and Adam Labar, and that's all about multifamily. So we have actually trained, 20, 30, maybe 40 syndicators who are actively finding and closing large multifamily deals. They've teamed up together. They're doing that. So by combining that side of the business on the acquisition side with the fund, we're really the perfect connectors. So we're taking the capital, we're raising the capital from our community by educating them on, hey, you can actually get into these deals, kind of like you talked about, like where the retail investor is getting squeezed out, the non-accredited retail investor. Well, by removing all these barriers, no, come on in, the water's warm, right? And we're connecting them with our students. who are just crushing it right now because, you know, they have the military background. We've educated them on everything they need to know, and they've teamed up together. So that's our deal flow, and we're truly the connectors. So, you know, the first fund, which we're calling Equity Fund 1, is, like you said, it's a special purpose vehicle. It's a $10 million raise, and we're going to put that in like 3 or 4 deals. And, you know, pretty much the game plan here is we have the deal flow on the self-storage, mobile home park, RV park, and you know, traditional large multifamily side. We're going to cherry pick the best deals, and we're going to be the major equity players. We're actually going to co-invest. And in some cases, we're going to turn that deal from a syndication into a JV, depending on how much is needed. But we're going to be writing the biggest check. And, you know, we're going to be working with the people that we've worked with. So we know that the deals are good because we told them and taught them how to find the best deals. So it's kind of like that circle of life. We call it we kind of call it our ADPI ecosystem, right? Where we're investing, we're letting the community invest in, you know, our community of multifamily folks and commercial operators, which is really cool.
You know, Brian, we've talked a lot about this when we talk about fund structures and such. And the one common theme that I continue to hear is flexibility. There seems to be a lot more flexibility in both strategy and actually allocation of the fund and the capital within the fund per deals. What do you think?
Yeah, definitely a lot of flexibility in these deals, which is why they're attractive and why we've seen a lot of success, especially if you're creating your own fund and you're an operator. Kind of what Kevin's saying, this ecosystem. Some people are doing that on their own, or some people are in these types of ecosystems. Man, the amount of volume you can really do, and the amount of credibility you build with the brokers. You say like, look, I've got a $10 million fund that's already raised, and I'm starting my second one now. You know, we're about to do 20 for the second one or whatever. It just gives you that assurity at close, which is a huge lever to pull. So that flexibility piece is super important.
For sure. All right. So Kevin, we've talked about kind of like a little bit of the cons. All right. So you have, it's obviously very expensive to set up, you know, these type of fund structures, very time intensive, like you said, 6 months, a lot of paper trail. So a lot of reporting out, you know, so there's cumbersome to say the least, as far as the management of the fund. But on the positive side, like you said, you can access so much more capital within a like-minded community. You can, you know, really have a lot of flexibility in the deals that you're you know, providing equity for. So there's a lot of benefits. I want to kind of make a quick pivot and look at this from the angle of the passive investor. Like, hey, I want to invest in a private placement, but where's the best route? Should I go the traditional 506c(b) route, or should I go the fund route? You know, let's look at it from that angle and talk to us about why we should consider looking at a fund structure as a passive investor.
Yeah, no, that's a great question. So if you consider your options right now, which I'm sure your listeners are familiar with, you know, kind of 506b, 506c, you know, your 506b, it's a great option, especially if you're not accredited. The only problem is you have to have a pre-existing substantial relationship with the operator. So you don't know what you don't know. No one does. And if you don't know these people and they're not in your network, they're not in your space, you can't prove that relationship, well, then you're going to have a hard time getting into these opportunities. Not to mention, are they going to have space because they're capped at 35, you know, non-accredited investors in their deal? So there's that aspect to it. The 506c, obviously, you know, if you're accredited and you're a passive investor, the doors are going to be more open to you. But I will caveat this, keep in mind that there are rumors, and I'm sure you guys have been tracking this at the SEC, that they may change that accreditation rule. That rule hasn't been touched since the 80s.
Yep,
y'all, the 80s. So that net worth requirement might be 10x to $10 million. That is going to destroy capital raisers who are not prepared. That is going to destroy them.
Yep.
You know, because yeah, I mean, let's be honest. $1 million in 1984 was a lot of money. $1 million in 2022, it's a lot of money, but it's not as much as it was. You know, like it just, you know, that is what it is. So if that rule does change, that's going to send shockwaves through the capital raising space, because people just won't be able to get into a lot of these deals. Now, the fund aspect of it offers, I think, a blended solution, the best of both worlds, because a non-accredited investor is able to get in. So great. You don't have that barrier like we talked about. There's not these ridiculously high minimums. And the reason that these minimums exist in the 506B and 506C side is because a lot of the times they're only allowed to have 99 investors in the deal. That's 3C1, that's 30s and 40s X. Like, it just is what it is, right? So, depending on how much equity they need to raise for the deal, they can't have a $500 minimum. That ain't gonna fly. So that's just math. But on a Reg A, you have way, way, way more investors. And if you're using a transfer agent, it's almost unlimited investors. So there's that opportunity. So by having more investors that you're able to raise from in one opportunity, you're able to vastly lower your buy-in price. So it's not as intimidating. And then also you get diversification. When you're in a fund, like we talked about, most syndications, they're single asset deals. You're in that 506B or 506C for 123 Main Street apartments, and that's it. And there's nothing wrong with that. If 123 Main Street apartments is a freaking rock star deal, then great, you'll double your money in 3 years and laugh your way to the bank. But if it's not, you're screwed. So when we talk about, hedging risk, when you're in a fund like ADPI Capital and Equity Fund One, where we're in 4 or 5 different deals, if God forbid, if one tanks, we got 4 other deals that are helping us out. And they're all across different sectors with different operators in different markets. So the odds are in your favor. I mean, barring a, knock on wood, massive collapse, you're going to be fine there. So, from the passive investor side, if you're considering a fund, you have a low barrier to entry as far as the accreditation. You don't need that. The low buy-in. You get relatively competitive returns. You might not get as the best returns as a single asset. You might not, because it's blended, right? That's just how it works. But you're trading that for diversification and you're hedging a whole bunch of risk. So I like to consider the fund option for new passive investors, or seasoned, but mostly new passive investors who want to dip their toe in this space, because they can start and they can understand and they can learn from the operators, assuming that you're with a good operator, right? You can learn from the operators and you can say, hey, okay, now I know that I love mobile home parks, and I'm going to go find some 506B and 506C opportunities that are just for mobile home parks. I freaking love them. But you'll learn about it. So, ultimately, what I like to say at the end of the day is, you're not, as a passive investor, and you guys both know this, you're never investing in the asset. You're investing in the team. Money is not the common denominator here. It's trust. You have to have a pathway to develop trust with your GP team. If you don't have that, then you're going to, you're not going to have the best experience, just straight up. Like, if you could, sure, you can go and put all your money in a Vanguard REIT. Are you going to have a conversation with the REIT manager? No, it's not how it's going to work. It's just not going to be that way. So, and then one final benefit from the passive investor side, if we're comparing, syndications, REITs, and funds. In syndications and funds, you're getting K1s. In REITs, you ain't getting that. You're getting, pretty much disbursements from your REIT, but they're not, you're not getting tax benefits. So consider that as well. And then something cool that we've put together specifically for our for Equity Fund One is, we don't have any fees, no management fees, no acquisition fees, no nothing, because that's not why we're going to offer access, as high of access as we can offer, and then fee people to death. It's not how it works. It's stupid. So we don't do it. And I think we kind of turned the, the syndicator operators listening to this are like, oh, but what about my acquisition fee? It's okay. It's okay. I trust me.
Yeah, well, listen, you brought up a lot of great points there, and appreciate you, going into granular detail about that. I think the one thing for us that really stands out is, like you said, the diversification of risk. And I know one thing that, Brian, we've seen this, right, where we're going out and competing against people that may have funds in place. And in contrary, we're actually seeing some funds being able to deliver higher returns because they have a blended portfolio, right? It's much harder when you're looking at a single asset that only has a certain business plan and execution strategy to produce a certain return versus when you have multiple stacked into the fund that can produce varying levels of cash flow and, you know, whatever. So I think that has been one competitive advantage that fund managers similar to you guys that have over us is you can get very creative in the assets you're bringing into the fund, therefore producing a diversified risk, but also a better return profile. And so I think that's important. But Brian, what are your thoughts on that?
No, diversification is the name of the game. And Kevin did a really good job. I like the way he described it. Obviously, a seasoned investor can obviously invest in a fund as well, but I like it as that entry level conversation for somebody who's maybe a little bit younger. Like if I was, you know, right out of college, 23, 24, or whatever, and maybe I have $10,000 and I want to get into real estate, but in today's market cycle, you're probably not buying a single family house with a $10,000 down payment, at least by yourself. You're definitely not investing in a 506 B or C with $10,000. So, you know, you're sort of left with a very limited options in this fund model, as long as you're aligning with the correct fund manager who then goes and aligns with the right sponsor. It's a great way to go out there, gain that knowledge, gain that experience, gain that trust, so that as you progress through your professional career, you start making a little bit more money. Now you've dipped your toes in a bunch of different things and you know which asset class you really like, which sponsors you really like, and maybe you continue to invest in the fund, or maybe you go the other route, as Kevin alluded to, and you say, hey, I'm ready for some specific deals, 506Bs, 506Cs. But I love that sort of progression. You can paint that in somebody's head of how it can be a really powerful long-term wealth building strategy.
Yeah. And I'll say this too. I'll tell a personal anecdote here. There are so many, because we're talking retail investors, right? You know, first of all, there are funds out there for the institutional folks, obviously. You know, there are funds for the endowments, there are funds for the pension, you know, they're pension funds, right? But when we're talking retail folks, there are so many people that do not understand the power of multifamily real estate. And that's why I love being on podcasts like this, because, you know, you guys are spreading the word, right? I had a conversation with my brother, airline pilot, makes a good amount of money, right? Good amount of money. And no clue, has no idea. He's asked me, should I sell my house in Oklahoma? And we're going through the exercise. And I was like, yeah, you know, he stands to make about 300K on the house. And I was like, yes, you should sell your house, but only sell it if you're going to do something with that money. And no clue about passive investing, no clue about multifamily. But the big thing is, folks don't even know, most retail investors don't know about the benefits, the tax benefits alone, and how you can go and take, even if you have a W-2, you can take $25,000 and apply that towards another passive gain in your portfolio, which is huge. Taking those passive losses is absolutely huge to reducing your tax liability. And I think from a capital raising standpoint, if you're talking to, or your listeners are raising capital, they're trying to, you know, have these conversations with retail investors, if you can find a way to explain this tax benefit without boring people to death, and you can really create some influence and make some waves for whatever deal you're raising for, because people just don't get it. They really don't. And like you said, 10 G's, it's not going to get you into, it's not going to get you into ownership of even a rental property, but it sure as heck will make a dent, and it'll get you some, on a fund like ours that has a $500 buy-in at $100 a share, that's going to get you some ownership. That's going to get you some equity, and it's going to get you some great tax benefits along the way too.
Well, like you said, Kevin, what it does is it gets them exposure, right? It shows them the power of the velocity of capital, keeping your capital invested in real assets, and the benefit of that. And so for them, it becomes a financial strategy where, hey, this is great. I need to duplicate this. How do I continue to build my wealth utilizing this strategy? And then they can start planning for their long-term financial future. So I think that's really great. Now, let me ask you. So, in our syndication models, we focus on 506C. We work with accredited investors, but it really doesn't matter, B or C. We typically have investment mens, and depending on circumstances, at times we make certain accommodations. Are you setting a specific min within the fund, like you said, 5,000, 10,000, or does it vary between investors? Is it flexible?
No, so we and we had these conversations back and forth because I came from your world, right? I came from the 506c world. And I was like, guys, the minimum, like this is us planning, about a year ago. I was like, guys, the minimum's got to be like 10,000. And, and Eric and the other founders, they all looked at me and they're like, but that's not our community, man. That's not our community. You have to tailor your product. It has to have a product market fit, right? You have to tailor it to your community. So we looked at it and we said, you know what? $500 minimum. You want to get in on this? It's $500 minimum. And the next fund, just like you do with your Reg D 506B and C, I mean, in your private placement memorandum, you're writing the rule book, right? You do the same thing on the Reg A. It's a different rule book, and it's bigger. I guess it's more pages, but you're still have control. So the next fund we do could be $1,000 minimum, $5,000 minimum. Doesn't matter. But by keeping that low and standardized across the board, we've seen a tremendous response. And I mean, and we went live with this a month ago, and have over 2 million in commitments, just like that. And we're still waiting. We're working with the SEC on this. Like, this isn't even qualified yet because we're going back and forth and this and that and the other. But we know, just based on that response alone, 230 people putting in money, that they're ready, they're willing, they're excited, because it's it's a solution. And like anything, whatever you're doing in business or in life, just create a solution for other people and you'll attract them.
It's interesting, Brian. This is a little bit of a mindset shift, really, when you're looking at this Reg A fund. And we've mentioned this with one of our prior guests, Mrs. Alex Brashears, because she also operates a Reg A fund as well. Mm-hmm. Very similar to you. Like, it's giving people access that wouldn't normally have access, right? But for us, and it's not to discredit the sophistication or the credibility of an investor who can only invest, let's say, $1,000, $5,000, $10,000, whatever the case may be. It's more of, as a capital raiser, the mindset around, do you really want to be accepting funds from somebody that can only be investing $1,000? Typically that probably means that they're not in a strong liquidity position, or they're not earning enough of an income, or whatever their situation is, right? So does that ever give you some discomfort as far as, man, if you think about, man, if only getting $1,000 investments from, 2,000 people, like, do you worry about the economies of scale, so to speak, when you have such low investment mins?
Yeah, I think, initially, yeah, you do, but you also have to factor in that you have to have really strong systems in place. And there are software solutions out there that really, from portals to marketing to email to everything, that you can get the word across relatively easily. And, you obviously you hire outside auditing firms, and you hire, CPAs and stuff to, big accounting firms to do all your K1s and stuff. But you get the solutions out there, and it makes that, it reduces that mountain to a little bit of a molehill. You know what I mean? Like, it's like, oh my God, I'm going to have 2,000 investors, and they each going to have 10 questions. And it's like, that's like 20,000 questions I have to answer. No, you don't, because you can record a video, you can send it out to everyone. And with all the questions, you can have an FAQ landing page with all the questions and constantly update that. And it really, what we've noticed is it's really not that bad. As long as you explain everything to folks in a way that makes sense. We really don't have that many questions from people. Like, I thought, and I'm the director of investor relations, like that's my gig in this, beyond being a co-founder, but like, that's my role. And yeah, I was sweating it a little bit in the beginning. I was like, this is going to be bad, but it's not, because it's all about the systems you have set up. And shout out to Alex as well. She, believe it or not, she was one of my students, early days. But she is crushing it in the, she's about to actually release a book with bigger pockets, and mm-hmm. she's just crushing it on the private lending space. I love everything that she's doing.
Yeah, we do as well, man. I mean, she's awesome person, and very similar to what you guys are doing over at ADPI, right? She's creating this community of education and networking that's just giving people access to, something that maybe they couldn't find on their own, or make it just so much easier. And so, of course, military wife as well. So we appreciate her commitment and service as well. But it's good to be in the same circle of friends here, even though we're not military personnel, so to speak. So
you're welcome. You guys are welcome to join anytime. Just don't make me go to Houston and breathe in hot air. It's hot enough in DC. I don't know.
Yeah, we want to break. We want to escape. Brian, if we go, I'm Maverick. You're Goose. All right.
Okay.
Oh,
okay.
snap.
Yeah, this is going.
I haven't seen the new one.
I was going to ask you, Kevin. I got to ask you a review.
No, I really want to see it. But to be honest, I've been come down with COVID in the last. I'm on the tail end of it, so I feel fine. But I'm still locked away in the house for the next couple of days here. So, but that is on my list. And then I know Jurassic Park's coming out. I'm a total nerd on that as well. So very excited for those two films.
I didn't know there was a new Jurassic Park, but everybody's been raving about the new Top Gun. I mean, everybody. So I'm like, man, all right, now I got to go see it. So
it's good. I've seen it.
Yeah.
That's the official review. It's good. I've seen it.
Yeah. Probably while he was sipping his coffee, I'm sure. Well, Brian, anything else for Kevin? But I mean, I know we covered a lot of ground, and I think, man, we can go into so much further detail, but we're kind of getting near the end of our time here. So I want to be respectful of your time, Kevin. Brian, anything left on the table that you have unanswered for Kevin?
Yeah, I just want to thank Kevin for coming on. We don't talk to a lot of guests. I don't think we've had very many, if any, besides Alex, maybe about fund structures in particular. It's a big question mark for a lot of people. They hear the term thrown around. There's a lot of new syndicators in the space as well, or just people, multifamily investors that are trying to figure out, how do I get in? How do I get my foot in the door? And a fund seems like a great option for a lot of people. So definitely appreciate you coming on, Kevin, and sharing your knowledge with funds. And I would definitely encourage our listeners as well to check out your podcast, because I'm sure you talk in much more detail about some of these other things as well. So
yeah, absolutely. Yeah.
All right, Kevin. Yeah, we appreciate you, man. Before we wrap up, we got 4 more questions for you, and then we'll call it a show. How about that?
All right. Sounds good.
All right, Kevin. So what are you doing specifically to further your own education, to further your investing?
Oh, man. So recently I jumped feet first into the short-term rental side of things because, I live in DC here, and we rent because it's just stupid to get something. It just, financially it just didn't make sense to buy here because it's just ridiculous. But I hopped into the short-term rental arbitrage space. Oh my God. Cash flow, guys. Cash flow. It's nuts. People are staying at these homes that I rent the home, for $2,400 to $2,600 a month. They're paying $400 a night. So like all month, you know what I'm saying? So it's like, whoa. So, for listeners out there, and it's just been a little side project of mine, and it's great. It's really easy to run a super lean business. It's got a ton of flexibility in it, especially on the arbitrage side. You don't get the equity of owning a home or anything like that, of owning the actual property, but you get a bunch of cash flow. And, recently my wife and I went to Paris on that cash flow. So you can't beat that. So yeah, I've been working at that.
I have to make sure my wife doesn't hear this episode, because otherwise she's gonna be like, babe, I need to go stack up some short-term rentals. Brian, there's an idea. Look, there's your short-term rental in Colorado. You can partner with Kevin. Boom. Done.
Yeah. Done. Hey, man. Yeah, my brother also approached me about that. He's like, well, what if I just buy a vacation rental? I was like, you should do that, and I'll manage it for you. 10% down vacation rental loan. Stay there 2 weeks out of the year. You're golden.
Nice.
People don't know this stuff, man.
Good stuff, man. Well, Kevin, looking back at your path up to this point, was there a moment in time that really altered the trajectory of your business?
Yeah. I mean, honestly, I owe a lot of it to ADPI, active duty passive income, and they took a risk on me. 3 years ago, I was a dude on vacation with my girlfriend, now wife, in Puerto Rico, literally standing in a pool on a rooftop, shooting a live video, trying to educate people in this community of 1,200 people on Facebook, telling them how I got into this Quadplex. And now we're a community of 55,000, and I've been given the opportunity to host the podcast, completely turn that podcast around and host it now, and create a single family education program and kind of be the face of that, and then launch ADPI Capital. So my dream of becoming a fund manager, I did it. I tried it myself. And the one thing that I was lacking was the authority capital in the space, like the authority in the space. But by helping grow active duty passive income in that brand, I'm now cemented with them, and we're now owners and partners. And it's just so exciting. And to be on this wave, I don't know how else to describe it, of watching this thing that you built grow, and we're in that phase of like automating it. And it's just really, really exciting. So I owe a lot to them, and yeah, shout out to Mark Yancich, the CEO, for having that phone call with me 3 years ago and saying, "Hey, do you want to come work with me?" Because that's pretty much how it went down.
Awesome, man. Awesome. Well, Kevin, what single piece of advice would you give to listeners to help them grow their businesses?
Yeah, and I think I touched on it earlier. I'll touch on it again. It's solutions. Be solutions oriented. Just because all these other people, if we're talking multifamily and capital raising and syndication, and all these people are going after doctors, dentists, and lawyers to raise capital from. Yeah, I mean, you could do that too. But if you have specific knowledge of a community, you're part of a community, and you identify a need, then be solutions oriented and create a brand around that solution. And yes, it's going to take time. It's going to take effort. It's going to take long hours. You're going to have to learn how to become a professional marketer. You're going to have to be comfortable on camera. You might have to start your own podcast about coffee. But the point is, really, if you can provide that solution, it's not going to be instant gratification, but you will start to build that community. And from there, when you have an established community and you have an established brand that is providing that solution, the sky is really the limit, not only in that community growth, but in how you can utilize that community and run a business.
Kevin, that's such great advice, man. I really appreciate that. And Brian, we may have to borrow that one from Kevin. Solutions oriented. That's a really good one. So, all right, Kevin, how can the listeners learn more about you and ADPI Capital?
Yeah. So 2 ways. One, head on over to adpicapital.com. It's super simple, www.adpicapital.com. Or if you're driving, well, actually, no. If you're driving, don't do this. If you're at the gym, if you're whatever, you're listening on the go, you can take out your phone right now and you can text ADPI to 33777. And what that's going to do, it's going to drive you to ADPI Capital, but it's also going to get you on our email list where you'll get all the information that you want. I don't know, guys, when this one is going to air, but we're recording in June 9th right now. So I can't tell you that there's still going to be space in Equity Fund 1 by the time this comes out, but if there is and you're interested, check it out. It is really, really something special. We're very proud of it, and we've really brought together literally some of the best military real estate and commercial real estate investors on one team together to make this happen, and we're super stoked. So any of those things you can find me.
Awesome. Kevin, I want to thank you again for being on the show, man. Thanks for all the great insights here. Again, thank you to not only you, ADPI, and all of our military men and women. Appreciate your service. Appreciate what you're doing for the community, guys. Keep crushing it.
Thanks, y'all.